So how to, walk away from this analysis paralysis and create a pave a safer path for us to make the right decisions when we are investing?
Um, there's a great way to deal with analysis paralysis. Because through your analysis process, you're going to run into negatives. It's inevitable. No deal is perfect, like you just said. There's always, and really, let's change the wording here and use a slightly different word: risk. There is risk. Like you might run into what you quote a problem. Well, okay, that's just a risk. And to earn a return, there has to be risks. People throw the word around like arbitrage, and I laugh because people throw it out on LinkedIn and everything else, and it just kind of churns my stomach a little bit because they're using the word the wrong way.
Wrong terminology.
And arbitrage is something that is incredibly rare, and unfortunately, people like me, you, and everyone else, we're not big enough to actually capture a true arbitrage. That's absorbed by thousands of people and machines and billions of dollars, maybe trillions of dollars, that's working out of all the money center areas around the world.
Real Estate Vibe Show, and I'm your host, Vinki Loomba. As a real estate investor and a fund manager, I'm always excited to explore the world of real estate opportunities with you and for you. Today, I have a very good friend, Chris Carsley, with me. Welcome, Chris, to the Real Estate Vibe Show.
Well, thank you, Vinki. Thank you for having me.
Likewise, I'm super happy that you're here with me today, Chris. Chris, CIO and managing partner of Kirkland Capital Group with 29 years of investment expertise, specializing in portfolio management, risk evaluation, and commercial real estate bridge loans. Chris has served as a diverse range of clients from individual investors to family offices. A co-founder of the Seattle Alternative Investment Association and a CAIA Pacific Northwest executive board member, he brings a wealth of knowledge and leadership to the finance sector. Today, we have an interesting topic. We're going to be talking about building a strong foundation and navigating due diligence. And we all know due diligence is a process of thoroughly evaluating an investment opportunity before committing your capital. It helps passive investors assess risk, verify credibility, and ensure that their money is placed in a secure and profitable venture. By conducting proper due diligence, investors can protect their capital and make more informed decisions. So, Chris, before we get started, I had a question with your background, this Kirkland brand. Are you associated with Costco? Let's talk about that a little bit.
Yeah, no, I'd like to be associated with Costco if they had a check for me for my fund. No, it's real quick story. We had an office in Kirkland, Washington, and back in January of 2020. Now we all know what happened in March. And for those people who are listening, if you didn't know, that Kirkland, Washington was the first site of the first, case of COVID. That was his assisted living. And that assisted living place wasn't too far away from us. And just being in the city alone, my wife and Brock's wife were like, yeah, you're not going to have an office there. But in a roundabout way, whether we were forced or we wanted to, I know Brock was happy about going on to being, fully virtual. So that's what we are. We're a very virtual company. We have a series of hot desks and a variety of other things, but most of us work virtually, and we're not in Kirkland anymore. Interestingly enough, even though COVID is now, subsided to some degree. But yeah, that's the nature of the name. But yeah, if anyone from Costco is listening to this and Kirkland Signature Brands wants to talk about investing, I'd be more than willing to take that phone call.
That's super awesome. I thought you associated with now from Costco,
Yeah, well, I mean, why not?
Awesome.
Or I get even deeper discounts on all their private labels. I mean, I'll take that too.
That's true. That's what I was looking for. You might have friends and family discount. Maybe I can use that.
No, sorry, unfortunately. I pay and wait in line like everyone else.
Okay, let's go back to our today's topic, navigating the due diligence. So as a passive investor, what are the most important factors to look for in a potential investment opportunity to make sure that is solid?
I start pretty high in that filter. I can use myself as a little bit of an example because I am an investor. I invest, not only do I run, the Kirkland Income Fund, I've been investing in a number of different alts, for decades. And one of the things that I always tell people is identify what you want in your portfolio. You already own a certain number of things, and maybe some of those are traditional, some of those are alternative. What else do you want? What are the other opportunities out there? And I always tell people, if you happen to end up being passionate about it, that'll only help your due diligence process. Because if you're not really excited about something, it's really hard to do research. But I always say, start at the top of the filter and say, hey, I'm looking for real estate. I want equity in real estate. That's what I don't have in my portfolio, or I want more of it. And as you are sitting in front of your email or social media and just this deluge of opportunities that everyone seems to have, and everyone's looking to raise money and they're just shoving one idea after another into your face, ignore all of that or put it in a folder for later consumption. Focus on what you want to achieve. And if you don't, you'll find yourself distracted, not doing proper due diligence, and one, probably taking longer than you need to with regards to identifying that thing you want for your portfolio. So I start pretty high in that filter. Identify what you're looking for. And then there's a plethora of things underneath that I'm sure we'll cover some of them in this podcast.
Okay, so once you identify what you want to have in your portfolio, what steps do you take to conduct a due diligence? And specifically from the passive investing perspective, because you're doing passive investing too, right?
Yeah. Oh yeah. Let's just deal with the passive investor, not the hybrid of, hey, I'm trying to do some passive, some direct, or all direct. But as a passive investor, you might look at special purpose vehicles. We used to call them back in the day fund to one. People who are raising money for a single real estate deal or a single trade of any type. We just call them funds of one. But now people got lots of names for them, syndications and this. They are a syndication by definition. But let's just say you're going to deal with something you want from a fund. One, if you have a network, the sourcing of, how are you sourcing that? Are you getting that just blindly because you are out there searching? Are you part of a network that is invested in this? Sometimes you can start off pretty early and talk to other people who are maybe already in the fund, get their opinions, get their take. It's always a good start to get impressions. But don't invest just on that. Don't, oh, hey, my best friend's in it, so it must be good. That's not a good level of due diligence. That'll get you probably in trouble, and you and your friend will be in the same boat if something goes wrong. Misery loves company. But with that said, there's four sort of buckets that I sort of identify. One is investment due diligence. You've got operational due diligence. You've got business due diligence. And then you've got a fourth one that I think has been, as chaos has come back into the market a little bit, you're looking at economic due diligence. And I'll give a quick rundown. Investment due diligence is what everybody loves. I want to know the fascinating trade. I want to understand how it works. I want to look at the performance, and wow, that's super amazing. And that's where, interestingly enough, a lot of people spend a lot of time on that, because that's the fun part. That's the understanding the trade and talking about what's being done and how money is made. And that's great. And it is an important piece. Interestingly enough, if people are worried about risk mitigation, most funds fail not due to an investment failure. They actually fail due to something mostly falling into operational. And, that obviously bleeds, and there's some crossover between business and operational. So operational due diligence is anything and everything operationally about running the fund that has to do with the investment. So, if you're talking to a hedge fund, okay, what execution systems, who's their prime brokers, what trading systems they're using, who's their head trader, what safety and protocols do they use, in execution. Those are all operational structures that would directly relate to the investment. And then the business side of it is, well, do they have, proper computers and systems? And, you can go into some of the cybersecurity aspects of, what do they have in place for, safety of their systems? Do they have the right materials to just run the business? And so even though it's a little bit more operational, it's a bifurcation that occurred probably about 4 or 5 years ago where people, because business due diligence used to be all shoved into operational due diligence. And, give a little bit of history on this, and my background in it. This all started out of 2008. Pre 2008, the idea of operational due diligence made people shudder, groan, moan. It's like, what a horrible thing. Who wants to do that? It's a waste of time. And it usually was given to someone who was some accountant or some mid-level person within a large investment or allocation shop. It wasn't a duty given to someone relatively, high in the rankings. But post 2008, when you started looking through what was actually occurring, there was stress on the investments, but funds weren't breaking because the investments were down 23% or 24% or 40% in some cases. They had no idea what to do. They didn't have process and procedure in place operationally. They didn't have the systems in place. They didn't have the people in place to deal with that type of event. And so now, not only you had the investments failing, you had people, process and procedure failing. And there's a I don't know what it is now. It oscillates between 50 to 60% of fund failures that passive investors are going to be involved in actually fail due to operational due diligence problems, operation problems. And so the investment side is pretty fascinating, and you obviously need to understand it. But the operations is equally as important. It's the assessment of the manager's edge and what they have to pull off this investment. A lot of people are always like, oh, hey, what's your experience? Have you been through a cycle? That's kind of that bleed between the experience this manager has built process and procedure and operations to handle the investment, even in a time of risk. And going back in the day, there used to be a belief that there should be a Chinese wall between people doing investment due diligence and operational due diligence. And this is an institutional level. And I always thought that was a bunch of bull. I thought that was ridiculous. Having been a hedge fund trader for 8 years and understanding the operations and the things I needed in place to pull the trades off, it wasn't all me. I mean, I couldn't sit in a room isolated by myself with a computer and just somehow make money. I mean, I needed people around me. I needed structure and operations and sometimes third parties that, were part of the trade. That was all part of, operations. That was all part of, the business structure, allowing me to pull off my trades. And to say that I'm going to go assess an investment without understanding the middle and back office that carries that trade forward seems kind of ridiculous. And I sat on a panel once, and people argued with me that you should have these totally separated, and operational people shouldn't talk to investment related due diligence people. And I was like, well, okay, would you invest in a company that had a product, but you never visited the factory that had the assembly line that built the product? Would you?
Yeah, but
Of course.
that's
And of
still
course, the
more
answer is,
internal,
of course, the answer is no. You would always want to go see the factory, and you want to see the process and the operations and the structure of how the product is built. Well, it's no different than any kind of passive investor. The product and the assembly line, that's the team, that's the people, that's the process and procedure, that's the systems, that's the risk management, program, whatever's involved in the trade you happen to be looking at. And then, lastly, the economic. Well, geopolitical risks are a pretty big deal now. It's probably one of the biggest things that's on most people's minds about what's left of uncertainty as we look at the face of, hey, maybe the Fed's actually going to ease rates this month. I mean, we'll see. But with increased chaos and economic impacts, and we're being far more global in our exposures, something happens around the world that can affect some of the investments we're in. Even if they're related here in the United States. We saw some stuff with supply lines back in 2021 where, we had loans to people that they couldn't get doors. I mean, so, luckily we put them in a 12-month, and they were like, hey, we only need 6-month loan. I'm like, just do a 12-month. There's no prepay, it's not a big deal. And they're like, oh, thank God I took a 12-month because I haven't, I got an 8-unit multifamily and every single one of them doesn't have a door on it. And, but they're due. And so, I mean, those kinds of, situations, understanding the economic impacts of what can occur is sort of that last bucket of due diligence. And that applies to all trades. There are things that affect venture. There are things that affect, long short hedge funds. There's things that affect real estate. And understanding what those can be from an economic standpoint can keep you on your toes. And so that maybe you're changing a process or procedure. Maybe you're just staying dynamic as a passive investor and understanding, I like this idea. I love this manager, but maybe I, crawl, walk, run into this trade as an exposure. So instead of writing my $500,000 check, I start with 100, even though I know that's not the allocation I want for my portfolio. Maybe it's, I'm not saying people should try to time, but if you do your proper due diligence, you might say, okay, hey, I want this exposure, but risk of dollars, maybe I shore that up. That's just kind of a decision process you can go through as you're looking at different exposures that it may not be the best timing. It's still something you want in your portfolio. So you're going to add it because you've done the work and found a great manager and a great product. But maybe you just size it differently.
Yeah, that's true. But the thing is, most investors, they focus on the investor due diligence. So let's talk about that a little bit. If you're an investor, and then what questions should a passive investor ask a deal sponsor to ensure the full transparency? Because that's very important, right? Before making any kind of commitment, because they need to have the basic foundation, like you were talking earlier. You gave me the topic, actually, building the foundation. That's going to be one of the building block, actually. For the foundation, so let's talk about that a little bit.
The first step before you start trying to throw in questions is, excuse me, educate yourself on what it is you're trying to do.
Achieve.
Because it's really hard. I mean, there's checklists for everything. I mean, you can go out and I can say, hey, you got a checklist of things that you asked Joe for this. Great. And you can send that to me and I can walk through the checklist. Am I just checking boxes? Do I really understand the answers? And do I understand the next level question that comes from asking that initial question? Because I always viewed a checklist that is an opening question that then can beg further questions on that subject. And those secondary questions are the ones that, you're asking about, like, hey, what do we really ask? And obviously that's different, depending on the, investment you're looking at. So first.
Yeah, you're so right about that. I'm going to interject for a second. Like you said, the basic understanding, and you raised a very good point, because if you do not have the basic understanding, you do not have any questions.
Correct. You don't know the right questions.
Exactly. You do not know the question because you do not know. You just basically just looking at the numbers. Oh my God, it's giving me 20% return or 30% return. This is good enough for me. And then how do I get this return? Not my concern that much, because I just trust the sponsor, basically. A lot of times we have seen that happening too.
Yeah, no, I mean, I'll let you know how we looked at when we did, because I worked for a large institutional allocator, and we wrote to, we were a fund to fund. So we basically invested in just a series of funds. We looked at performance as kind of a secondary. I know that it's important. And obviously, you have an expected return that you're looking for a certain asset class. And it's important to understand, is this going to meet my expected return for, say, this private equity investment or this private debt investment? and that's a good mental process to go through. It's one of those things when you're looking at fixed income and you're saying, okay, I can go get traditional returns that are 6 to 7%. I know I want to be north of that if I'm going to add something else that has, other risk factors to it in the alternative space. So, once you've educated yourself and you feel like, okay, hey, I do have a set of questions, and some of those questions might come from, I educated myself, but I couldn't get the answer. And that's kind of a weird way to think about generating the question is like, I read all this and I talked to a bunch of people. Go. Network is super important. If you're trying to do due diligence on a subject and a fund that you don't know anything about, and you're on an island, good luck. I mean, that is super hard. I mean, when we would run into a new trade idea, we would spend months, and we're talking about a team of experts that this is what we did as a living,
Mhm.
I wasn't a doctor in the daytime or a dentist or, something else and then doing this on the side. This is what I did for a living. And we would still spend months understanding new ideas and new trades that we hadn't seen before. Um, and so don't be in a hurry to write a check.
So true.
Make sure you vet things out, that you ask your questions, you get those answers, take those answers to a network or somebody else who does this, and walk through and then hear the hardships that maybe some people in your network have had. Let me tell you, there's a lot of people with hardships right now. So if you're looking for people with hardships right now as a part of your network to understand what not to do, you should be able to find them pretty easily. There's, especially in the real estate world, there's a lot of people who stepped on some landmines, and it had nothing to do with them not being good investors. When the Fed raises faster than anyone's ever seen, you were on a perfectly great path. You just didn't realize someone put a landmine on it all of a sudden. And that's hard to beat. So don't beat yourself up if you're one that stepped on a landmine. But if you're a new investor looking for network, great. You should be able to find a number of people who've made mistakes and how they've adjusted their due diligence process to look at those mistakes. Because I guarantee you this, if I'm in your network and I only tell you about all the great trades I've made and all the money I've made, I guarantee you how much you're going to learn: close to zero. We unfortunately learn from getting hit in the face.
That's so true.
It's a sad truth, but you paid for college. And if you're going to go into alternative investing and you're going to do due diligence, you're going to be paying tuition in one way or another. And the more you can learn from other people who paid tuition and you can go get free education, the better you are. Network is super important. And that should help you broaden that breadth of that initial checklist question into other sub questions from whatever you're looking at. But yeah,
Yeah, and then you have to learn in between, learn to read in between the lines too.
correct.
When something is presented to you, you have to learn. Nothing is black and white, and no good deal is a good deal either, because you have to learn to see the gray area as well. And then you have to trust the process sometimes, because there is too much information available out there. Now, Chat GPT being there, answering most of the questions there too. What happening is like it creates analysis paralysis too. So let's not forget about that. So I would like you to talk about that too. We talk about a bunch of things: get the information here, educate yourself, do this, do this, do that. But this is all the information, collecting or storing all the information, right? And then utilizing that information for your benefit is more important than anything else. And that's where the analysis paralysis come. And then people just sit on sidelines and like, oh, I shouldn't have listened to him, or I shouldn't have listened to her. I should have done this. All should have, could have, kind of become showstopper for you. So how to, walk away from this analysis paralysis and create pave a safer path for us to make the right decisions when we're investing.
There's a great way to deal with analysis paralysis. Because through your analysis process, you're going to run into negatives. It's inevitable. No deal is perfect, like you just said. There's always, and really, let's change the wording here and use a slightly different word: risk. There is risk. Like, you might run into what you quote a problem. Well, okay, that's just a risk. And to earn a return, there has to be risks. People throw the word around like arbitrage, and I laugh because people throw it out on LinkedIn and everything else, and it just kind of churns my stomach a little bit, because they're using the word the wrong way.
Wrong terminology.
And arbitrage is something that is incredibly rare, and unfortunately, people like me, you, and everyone else, we're not big enough to actually capture a true arbitrage. That's absorbed by thousands of people and machines and billions of dollars, or maybe trillions of dollars, that's working out of all the money center areas around the world. So, when I was working for a hedge fund, I saw true arbitrage, and everyone's like, oh my God, how do you do that? One, people thought it was fake. Like, that's not real. You can't do that. And I said, well, okay, multi-billion-dollar hedge funds operating on this, so it must be real, because I'm sitting here every day and I'm making these trades. But an arbitrage is you are earning a return for truly zero risk.
Mm-hmm. And how would you do that? Share with us.
Okay, that's a whole nother conversation. Let me make sure I answer the question of
Mm-hmm.
we're not going to talk about hedge fund arbitrage trading right now. That's all. That may be a whole nother podcast. But let's think about risk. And you're going to go through and assess in your due diligence these risks.
Mm-hmm.
Those risks are usually acceptable because they are risks that are inherent to whatever trade you're looking at. There's no way to get rid of those risks. That's the risk you're taking by being an investor in said investment. One thing that you need to ask is, and I love asking this, is, ask the manager what he thinks his risks he's taken.
Mm-hmm.
What does he identify the risks are? Because if he's got skin in the game, which I mean, I won't invest in anything where I truly can understand the person's got money in it. So that person is taking a risk. Now, of course, they've got, generally more transparency and a variety of other things that are in their favor than being a true passive investor on the outside waiting to be told what happened. But how do they identify their risk? If the manager can't really identify the risk that you think are in the fund or this, or they can't, or you ask them, hey, what about this risk? And they don't have an answer of how they think about that, that's probably a pretty good sign that that's your non-negotiable. Like, this guy doesn't understand the risk he's taking. I should probably not work with him.
And that's called, you're taking a calculated risk, because you know that you can lose portion of your money, you can lose everything. There is all calculated risk that you're taking. It could double up too. It could go either way. As long as you're familiar with that concept, you will ask the right questions.
So these problems you stated, well, like I said, let's rename them risks. Be accepting that there are going to be risks inherent in any investment you make. And with that, ask these questions of, like, how does the manager think about those risks? And the next level question of that is, well, how are they mitigating that risk to the best of their ability? What are they doing to be aware of that? What are they monitoring so that they can maybe shift and be agile as maybe that risk starts to, rear its ugly head? Oh, hey, how are we going to deal with that? That's the thing that caught a lot of people off in real estate is there was always a risk of changing interest rates. But when it changes so fast, you can't move in time. And even though you're totally aware that was a risk. And that's why I say, unfortunately, there's just a lot of people that they couldn't recover from that kind of move, even if they saw it coming, because it was just too fast. I mean, and that happens. But let's use that as an example. Hey, we know that's a risk. How is he thinking about that? What has he structured as leverage? Maybe he's not reaching for the fences for some 20% IRR or some other ridiculous number. He's like, hey, I'm going to actually use less leverage, and, I'm going to put up a lower IRR because, we're going to put more equity into the deal. Simple equation. And so, for me personally, I've looked at people not trying to knock it out of the fence, over the fence. I mean, I want the people who are like totally aware that I'm going to use leverage. It's needed in most of these trades, but I'm knowledgeable enough and I can still put up a decent trade to where I can put up, a decent return plus tax, benefits and, everything else. And when the world turns upside down, I'm still actually alive. Now, we say that kind of hindsight 2020 here, because, I do know some people who thought that way and they're actually kind of having a heyday. They're like, well, yeah, things are under stress and it's not great, but we didn't lose a single property. We had no capital calls or anything else because we're the favored lender from the bank we're working with, because we're not lending much money, even though the valuation of the property has adjusted. We're still, we're not in a negative leverage situation. They're still positive. So, I mean, things to think about that. But that goes back to you identifying the initial due diligence question. What am I looking for? Am I swinging for the fences, or am I growing consistently? You got to make that choice for yourself. And I'm not saying you got to have one or the other. When I was managing people's money, we used a hub and spoke, like, hey, you've got a core investment portfolio, whatever that's made up of, that has certain risk factors that are well within, your risk aversion levels. And then, hey, I got this little spoke that comes off my hub that where, I'm going to take a smaller amount of money and I'm going to swing for the fence on that. And I totally realized that I could go to zero. I mean, it's just, you got to get into the mental attitude of what you're looking for. And that starts to structure your due diligence and what you're willing to do.
That's so true. And then I think it all boils down to the business plan too. paying a closer attention to the business plan, what this operator is doing, how they're doing it, what their plans are, and have they done that before? That's again part of the due diligence too, how successful they were. It's not always about how many deals they have closed. It's all about, how much money they have returned to the investors, or how much they have stick to their plan, or how many times they change the plan, or how fluid they are, or how easily they can, or how much resources they have, that how easily they can change the plan and come back to track. So all these things are matter, and the question should be around that. I think most of the time, in the deck that I shared with the people, or the pitch deck is shared with the investors, if it's telling you the complete story inside out from conception to completion, you should be able to see that thoroughly, read that thoroughly, and should be able to ask the right questions if you understand the business plan. And most of the people, I think, they do understand that, right? The business plan is not like exactly 100% about the numbers. It's like how we're gonna take, this current deal.
Well, there's also like, if you're talking about something like in real estate, the stress test assessments and things like that, that's where you get into that economic due diligence aspect of like, you can have a model. I mean, I can build a model that can show you whatever picture you want. I mean, yeah. What picture do you want to see? And I'll show you a model that'll give it to you. It's that next level of, diving in. And one of the things that, a lot of people, just wasn't part of the trade was, truly looking at the economic occurrences and what could happen or what was happening already in some cases, and putting together proper models that were stressing it accordingly. And you realized, oh, wait, if I stress this accordingly to what might have happened, economically, well, okay. It's like when you're going to do a rehab on your house and the GC says it's going to cost you $50K. It's a good estimate. You should probably just double that. I mean, and it's the same thing when you're looking at models. If someone says, hey, this is, what I expect, either you're cutting it or you're increasing it, whether, it's like, okay, how far can you stress that? And that gets complicated for a lot of people who are passive, who haven't really built these models before. But let me tell you, if you've got the time and you're not in a hurry, and the manager's willing to spend the time and walk line by line through a model and explain every entry to you, that's what we used to do. I mean, especially with new trades where people would show me some, esoteric arbitrage structure. And I'm like, okay, I've seen a lot of stuff, but I haven't seen this. So I want you to break it down like I'm in first grade. I want you to explain it to me like I'm a first grader. Don't leave any detail out because I'm not following you, and that's okay to admit that. And I think a lot of people get sucked into that of like, I don't want to be the dumb guy in the room. You're the guy. I'll let you know that you're the guy with the money. By definition, you're not the dumb guy in the room. You've done something to make the money. So the fact that you don't understand what someone's doing, or there's a little factor, I'm just not filling it out in my brain of how something works. That's not a dumb. That's just you do 20 other things in your day, and this question you're thinking about or this deal you're looking at is not one of them. So of course you're not going to know. And so, but I run into that. I've done in-person educational stuff since 2004. And it's so funny. You're talking about something really high level and you're in a room full of professionals, and you get to the end of the conversation and no one has a question. And what it's like, what that really means is hardly anybody understands what was talked about, and they just don't want to be they just don't want to be the first one to ask the dumb question. But the problem is about half the room has the same dumb question.
That's true. But the thing is, I feel like in my dictionary, no question is a dumb question. Because if you do not know the answer to it, that's the most important question for you. Who cares what everybody else thinks? They're going to think from their perspective. Let them think whatever they wanted to think. As long as you do not know the answer, ask, get the answer. And then if you're comfortable with the answer, just go ahead with it. We are really running out of time. I wanted to ask you one question, and please make it a short answer for me. I just came across your podcast, Passive Income with Purpose. Just recently, I saw that somewhere. So I wanted to ask you, what do you have in mind regarding the passive income with purpose? What exactly you meant by that?
The fund that we operate, it does micro balance bridge loans. And so we often operate in tertiary and secondary markets. So a lot of our loans are to minorities. A large percentage are to women. We're obviously writing loans in underserved economic areas. We're not in gateway cities. And so that's kind of the purpose side of it. And so, we're building these, very opportunistic sectors in underserved areas, and earning a really great return, for our investors by doing that. I mean, that's really the premise of it.
Oh, okay, thanks. Because I
Was that not
like
the answer you wanted?
answer I wanted. That's a good answer. Because I was just thinking that when you say, with a purpose, so I just feel like, everything should have a purpose, because if you attach the purpose to a profit, it becomes more meaningful to you.
Yeah,
So
and we never really
yeah.
marketed it that way. And if you look through any of our stuff, you'll never see us like, oh, we're impact or this. I mean, we just don't talk about that. But just de facto by where we're doing our business, we're definitely having an impact, and that's great. So we've got we're able to put up some really really great returns for our investors, and we're actually helping like I said, small underserved areas out.
That's really good. I do that too. I even vocalize that much either. I should though. So I do have a small nonprofit. It's privately held, so it's geared towards women and children. We support multiple initiatives throughout the year. And our investors who invest with us, by default, they're supporting our cause. We do not take any money from them. Just because they invest with us, and whatever our profit share is from there, we take portion of it and we just support all these initiatives. And I just feel like, this is my purpose being here. And then when you put the purpose before profit, it's all profit. That's the way I look at it, because
Yeah.
I just feel, kind of fulfilled mentally, physically, whatever way you wanted to put it. It's just like, okay, I'm doing something purposefully. So, which means a lot to me. So thanks for that answer. So since we're out of time, I'm going to ask you one golden nugget at this time for my audience.
One golden nugget. You've probably heard this before, and no one wants to do it, but you should do it anyways. Especially when our subject was due diligence. Read your documents. Go through, read the documents. It's literally the PPM and the OA and other associated documents are the rules of how your money is going to be managed. I've really seen way too many times, especially now, where people feel they were slighted in some way. And it was right there in plain English in the document. And it's like, well, you can be upset with that, but it was right there. It's what it said. It wasn't related to our fund. It was related to actually a real estate investment deal that I was in that, didn't do so well. And I'd sit in the LP rooms and listen to people complain about things. And I'm like, you're complaining about something that now you're upset, but it was right there in the document. And I don't understand why and so that's the golden nugget. I know it's not like some amazing, like, oh my God, but let's stick to the theme of what we're doing. You can't understand what you're doing if you didn't take the time to really read what you're deploying your money to. And it's the old standpoint. You spent so hard to make your money, and you're about to go write $200,000 check into some investment, and somehow people don't want to do the research of what
No,
time in.
that's crucial. That's crucial. You need to be vigilant about what you're doing. That's very important. So this brings us to a rapid fire round. I'm going to ask you 5 questions. You're going to answer in 1 word or 1 sentence only. Are you ready?
Okay.
All right.
It's like, the pressure's on. All right.
So remember, 1 word or 1 sentence only. Okay.
All right.
So first question is, what is one of the most important things that you have learned in your life, and how did your life change after learning it?
Network. Yeah, it's
like
you got a network. It's this is a world where we need people. You can't do everything by yourself.
That's so true. I agree on that 100%. What is one of the best book that you like to recommend to my audience?
One of the books that we still reference is Who Not How.
Oh, that's a good one.
Yeah, it's one that Brock and I we come back and reference often, especially if you're a builder. If you're someone who's building something and you're kind of like me, I'm always on the front line. You got to realize you got to get off the front line sometimes.
That's true. I know, but it's good for scalability as well, you know? So in one word, what does life mean to you?
Experience.
I like that. What is your biggest passion?
My family.
That's a good one too. If you could turn back in time and talk to your younger self, what would you tell yourself and why?
Shut your mouth and listen.
That's a good one because the more you listen, the better perception you have
Yep.
because you're learning so much. And I think that's a really good communication skill. I will put it this way.
Yeah, it's something I'm still not the best at, but that's definitely I smack myself up across the head pretty hard on that one and say, hey, I know
Yeah,
you
I
I
did
know
too.
you know a lot because I'm you, but shut your mouth and listen anyways.
Yeah, because the thing is, it's just being present in the present moment. That's what happens.
Mhm.
Because that's what a lot of us we forget because we think that we know this or we knew this, what's coming next kind of thing, you know, and we're ready for the answer already or question already. But being present in the present moment is gonna open up like whole sort of horizon for you, you know. It's very important communication skill. You know, I'm like really watch for that. Thank you so much for being on my show, Chris. I really enjoyed our conversation and I hope to have you back soon again. Any last minute comment and also share how people can reach out to you.
Sure. Well, thank you for having me. I mean, I really enjoyed this. There's the fact that I'm not looking at a deck and presenting randomly and droning on and on about some subject was nice for once. So appreciate that. This was a lot of fun. I was nervous about the 5 questions. I'm like, oh my God, what are you going to ask me?
You did so well.
No, so no, the best way to reach me is, I mean, you can go to our website, kirklandcapitalgroup.com. I'm real easy to find on LinkedIn. My last name is pretty rare. I know it's phonetic, but it's pretty rare. And I'm the only one with a CFA and a CAI after it. And my silver hair is pretty recognizable. So yeah, hit me up on LinkedIn if you've got questions, you want to talk about something. Um, I've been very fortunate. I've had a lot of different experiences across a lot of different alternative investments. And that's something that, like I said, for 20 years, I've tried to bring that experience and that knowledge that I've been able to gain and educate people. And I understand for about 12 years, no one cared because the market just kept on going straight up. But alts are definitely something on people's minds. And if there's something you don't understand, and I'd love to, try and help you out.
Thanks again, Chris. Appreciate it.
No, thank you.